Cheers. Welcome back to another Deal of the Week breakdown video. My name is Ricardo Carrillo, and if you are new here, I do a Deal of the Week breakdown every single week where I basically talk about one of my investors' deals randomly across the entire US that we've done, that we've helped our clients secure. And it's a real scenario about real investors. One of the things that I've gotten a lot of feedback on is that my real estate investors love to hear about what my other real estate investors are doing. And because of the fact that my team and I cover the entire US for financing, we get a really good bird's eye view on where people are going with their investing and what kind of strategies they're utilizing that are helping them scale their real estate portfolio. And that's really working in today's economy. I love to just go through those details and just kind of talk through what we did, what strategies we used, what negotiation tactic we did, because every deal is different, right? And no deal is ever going to be the same. And I think that if we can see the feedback of what other people are doing, we can leverage some of those strategies, and we can use them in other parts of the other parts of the world, really. So, like my clients that are doing specific things in California might not be doing the same strategies of what somebody in Ohio is doing, for example. Let's jump right into this deal. This was a pretty cool property because of the fact that my client was able to secure not only a multifamily property that's going to cash flow for him once he turns it into a rental, but he also was able to come in with significantly less money out of pocket. He purchased it as a primary residence, and so my client plans to move into this property. One of the questions that I get a lot is like if you have to actually move into your property when you purchase it as a primary residence. And the answer is that yes, you do have to purchase it. You do have to move into it if you're purchasing the property as a primary residence. You're going to sign documentation at closing that basically specifies that your intent is to move into the property. So it's important that you've moved into the property at least within 60 days of closing and that you plan to utilize that property as a primary residence. I have had people who have moved out prior to the 1 year mark, due to family reasons or due to work relocation or whatever the case might be. So like that, those things can happen. Although the rule of thumb really is that you want to live in that property for an entire year when you purchase it as a primary residence. Now, the loan type that we ended up using for this investor was a conventional loan. Now, conventional financing is like one of the most traditional kinds of loan programs that somebody can use when they're purchasing a property because of the fact that it requires less money out of pocket. You also get better terms on a conventional loan. Conventional financing is one of the loan programs that gives you the lowest interest rates, pretty close to the lowest interest rates out of any other loan program that exists. And there's three different types of occupancy, or what we call occupancy, which is how you can use the property. Now, the first one is as a primary residence, the second one is as a second home, and then the third one is as an investment. Most of my investors who are doing short-term rentals, they'll do the second home route or they'll do an investment route. And then most of my clients who are doing like a house hack structure, kind of like the deal that we're going to talk about today, where my client plans to live in one unit, then they want to rent out the other unit, or they want to split it by the room, that kind of structure. Those are typically done as a primary residence. So in this option, we did it as a primary residence. Property type was a duplex. The property was actually in Atlanta, Georgia, and it sits on a little bit over a quarter of an acre. It's 4 bed, 3 bath per side. So it's a pretty massive multifamily. It's total of 8 bedrooms, 6 bathrooms, 2,500 square feet, and it sat on the market for 180 days. When I saw that the property had sat on the market for such an extended period of time, I highly suggested to my client for us to negotiate a lot of money back from the sellers, which is exactly what we did, and you'll see how we ended up using that money. Purchase price was 490K. It's awesome to see that still in parts of the US you can buy multifamilies under $500,000. And it actually appraised over the purchase price. It appraised at 500K, 10K in equity already just off of the purchase. The minimum down payment for a primary residence is 5% down, especially if it's a multifamily. This client was a first-time homebuyer, and so although he qualified for a first-time homebuyer program, for multifamily specifically, anything that's a duplex, a triplex, or a fourplex, 5% is the minimum down payment. And so that ended up coming in at 24,500 for the down payment. Interest rate we ended up landing at was a 6.75, which is pretty good, I would say, for the pricing of where we were at when we did this deal. Principal and interest on a $465,000 loan. So that's just 465,000 was what the loan was after their down payment of almost 25K. Principal and interest came in at $3,019 with 22 cents. Homeowners insurance was a little bit more expensive. It came in at 267 with 75 cents. Property taxes came in at 678 with 87 cents. And then monthly PMI was relatively low. It came in at 108 with 62 cents. Now, property taxes we typically get directly from the title company. So whatever the title company is that's associated with the deal is the one who verifies those fees, and then they give that to the lender. For homeowners insurance, anytime you're doing a new purchase of a property, you have to go look at quotes and get quotes. And typically I suggest just go talk to whoever you have for your auto insurance. Typically you can do like a home and auto bundle, which gets you better terms. And so that was what this client had ended up doing on this deal. Total monthly payment came in just over 4,000, so 4,074 with 46. Now, I know from when I was talking to the client, they're definitely going to be able to rent that 4-bedroom side for at least $2,500, leaving him with only $1,500 a month of a leftover payment because he's getting such a significant chunk covered. It's actually going to be even less than what he was paying in rent previously. So to go from paying almost $3,000 a month in rent to now having a 4-bedroom of his own on one side and then renting the other one for $2,500, he's basically cutting his payment of like his what he was actually paying in half to live at this property, and already coming into it with instant equity. Total closing costs on this deal came in at 32,000. Can't write today. 32,379. It was a little bit more expensive with the time of the year, but you'll see how that got subtracted out here. Then we had 14,700 in seller credits, which was phenomenal. We had got money back, which was adjustments and other credits. So that's just because of the time of the year. 39, leaving our total out of pocket here at 37,806 with 62 cents. Now, was expensive in terms of closing costs because we not only bought a lower interest rate, but we also covered a lot of the other fees and escrows for the beginning of the year. So like anytime you get a new mortgage, the bank opens up something called an escrow account where you have to prepay your property taxes and your homeowner's insurance. And so that typically during the end of the year becomes inflated. It's more expensive. Just you're paying for more months due to the time of the year. And so that ended up getting tied into this. We paid for that with the seller credits. And then he came in with a little bit more than the down payment to close. But it just goes to show like what is still possible in today's deals. The deals are still there to be found. And he's going to go into this property, and plans is to purchase another primary residence after the 1 year mark. And so that's really what my team and I specialize in, is we create structures for people to say, hey, let's do this year, and then next year we can do this strategy. Or, hey, let's review your taxes ahead of time to make sure that you can actually qualify for the deal that we're trying to go after. So every kind of deal can be cut in different ways. Sometimes not every deal fits every single investor's buy box. I always say try to be as clear as you can with knowing what kind of deal you want to go after. I see so many investors doing these different deals across the US that for me, I just love to be able to tell everybody else what we're currently doing that we're seeing that's working. If you need any help with scaling your real estate portfolio, or needing the right resources to go to these different locations, my team and I have over 130 lenders that we work with in total across the US. We have over 1,500 realtor partners that we work with across the US. And we can pretty much put you in touch with any agent in almost any part of the United States to be able to find a cash flowing investment property. I hope you guys found this deal of the week informative. I know it's one of our last ones. We have next week's deal of the week video, which is going to be our last one for the year, and I'm going to have an amazing video for you guys. So if you haven't seen any of my other deal of the week videos, you can check it out here or here. Again, my name is Ricardo. I appreciate you guys listening and staying tuned this long. Please like and subscribe. I will see you guys in the next deal of the week video.